Okay, so chapter 6. This is the point in the book where we start to, rather than talking specifically and almost solely about debits and credits and adjusting entries and things like that, now we're starting to get into some more of the reporting and analyzing of the various accounts that we've learned so far. And so in chapter 6, we're going to focus on reporting and analyzing cash. So let's dive in. So chapter 6, learning objectives. We're going to define internal control and identify its purpose and principles, define cash and cash equivalents, explain how to report them. Like always, there's some analytical tools. So in this one, at the end of the chapter, we'll talk about days sales uncollected. And then we'll learn about how to apply some internal control procedures to cash and disbursements, and also how to prepare a bank reconciliation. All right, so defining internal control and identifying its purpose. Internal control is basically policies and procedures that are used to protect the assets of the organization, to ensure reliable accounting, to make sure the company policies are upheld, and to promote efficient operations. So the Sarbanes-Oxley Act, this came out in 2001, I believe. Um, Basically, what the act requires is that managers and auditors of public companies document, and then they also certify the effectiveness of the system's internal controls. SOX 404, the section 404 of SOX requires that management document and assess the effectiveness. And that effectiveness, or that documentation and assessment of that, does impact financial reporting. All right, so there's this COSO, or what we call the Committee of Sponsoring Organizations, and they list or provide the 5 ingredients of internal control, which are intended to add quality to the accounting information. It's the control environment, risk assessment, control activities, information and communication, and monitoring. So the control environment is really the company's structure, their ethics, and their integrity for internal control. Risk assessment is the process of identifying, analyzing, and managing those risk factors. Control activities are the policies and procedures that are in place to reduce the risk of loss. Information and communication, that's just how the information is reported to internal and external parties. And then monitoring, what are they doing on some frequency to assess the adequacy of their internal control environment. So principles of internal control, common to all companies. They establish responsibilities. They maintain adequate records, ensure the assets and bond key employees, separate record keeping and custody of assets. They divide responsibility for related transactions, apply technological controls, and perform regular and independent reviews. So the establishment of responsibilities, the tasks should be clearly established. They should be assigned to one person, and then we can then determine who's at fault if something goes wrong with that particular process. The maintaining of adequate records, so the purpose of that is really to protect the assets. It helps managers to monitor company activities. And it includes things like detailed records, using a chart of accounts, using pre-printed forms or pre-numbered sales slips, computerized point-of-sale systems. There's all kinds of controls that can be put into place to help make sure that the records are adequate, but they just list a couple examples here. Then if we look at the internal control of ensuring assets and bond key employees, so assets should be insured against loss. Employees handling a lot of cash and other assets should be bonded, so if they steal from you, you can get your money back. Bonded means the company's basically purchased insurance against theft by that employee. Okay. Then the idea of separate record keeping from custody of assets. So basically the person who controls the assets or has access to the assets must not also have access to that asset's accounting records. So whoever it is that's handling your cash receipts, you don't want that same person reconciling your bank statement. Okay, that kind of idea. Reducing risk of theft or waste of an asset. And then by doing that, employees would need to collude and agree in secret to commit fraud if you have separate controls, right? So if your cash receipt person, the person that's processing all the cash that's coming in your door, is in collusion with your bank reconciler, well then, perhaps they could, figure out some way to take money from the company. But if they're not in collusion with one another, then that bank reconciler is going to figure out if the cash isn't making it to the account. Okay. Also, you usually have somebody separate opening the mail than the person processing the cash receipts. That's also a third person involved in that type of a process typically. So all three would have to be in collusion in order for that control to fail. So it's that idea. All right. The division of responsibility for related transactions. So responsibility for transactions should be divided between two or more individuals. Ensure the work of one person acts as a check on the other to prevent fraud or errors. It's called separation of duties. So that same bank, cash receipt and bank idea that I was just talking about, that's what we call separation of duties. Okay. And then technological controls. So cash registers can make an electronic file or record of each sale. Time clocks can record the exact time employees work. Personal scanners can limit access to authorized individuals. Okay. So the principles of internal control are they're relevant no matter what technological state is of the accounting system, whether it's manual or fully automated. Technology today really helps improve managers' ability to monitor and control business activities and that kind of thing. But basically, the effect of technology is reduced processing errors. It helps you to separate duties. You can have more extensive testing of records. There's evidence of new processing, and then increased e-commerce. Okay. All right, limitations of human control. There's still carelessness, misjudgment, confusion, human fraud. If you're out to intentionally defeat the internal controls for personal gain. We talked about in chapter 1 the fraud triangle. So, and I forget who established it, but the thought behind it is that there has to be opportunity, financial pressure, and rationalization in order for fraud to occur. And then the other thing with the limitations of internal control is the cost-benefit principle. So basically, the cost of the control system must not exceed the benefit. So sometimes, even though a company may know that they could improve their internal control environment by, I don't know, changing this specific control, but it's going to cost an exorbitant amount of money, and the risk of not having that control is less than what it would cost them to implement it, then they likely won't implement it. So it's that idea. All right. Defining cash and cash equivalents and explain how to report them. So control of cash. So an effective system of internal control is one that protects cash and cash equivalents. And in order to be effective, it should meet these 3 basic guidelines. The handling of cash is separate from the record keeping for cash. Cash disbursements are made by check. Cash receipts are promptly deposited into the bank. So you don't want cash laying around your, business, right? All right, so cash and similar assets are called liquid assets because they can be readily used to settle such obligations. So cash is considered currency, coins, checking accounts, deposits, and bank accounts. Also includes customer checks, cashier checks, certified checks, and money orders. Cash equivalents are short-term, highly liquid investments that are readily convertible into cash, and the maturity date is close, and it's not sensitive to changes. Okay. Cash management. So one of the main reasons companies fail is the inability to manage their cash. So cash management's pretty significant, and the goals of cash management are twofold. One, you want to make sure that you plan the cash receipts to meet when the cash payments are due. Seems simple, right? Easier said than done. And then keep a minimum level of cash that's necessary in order to operate, right? So effective cash management involves applying the following principles. So you want to encourage collection of your receivables. So that's the idea. One of the ways companies do that is that's the idea from a couple chapters ago where they give you a discount if you pay early, right? That's one principle of cash management. You delay the payment of your liabilities till you absolutely have to pay them, right? And then you keep only necessary assets. So you don't want to tie up a bunch of your cash in inventory, let's say, especially if you have an inventory turn of 80 days or something that's pretty long. You want to plan your expenditures. So that's usually done with budgeting, right? So if you do a good job budgeting before the year starts, you kind of planned out when you want to pay what expenses. Now, inevitably, things arise that are unexpected, but um, if you plan your expenditures by way of maybe creating a budget, that's one way to help manage cash. And then you want to invest your excess cash so you can make interest and things like that. Okay. All right. Applying internal control to cash receipts and disbursements. Okay, so if you're a business that takes cash receipts like over the counter, right? The illustration they're trying to show here is that none of the people involved can make a mistake or divert cash without the difference being revealed. So the clerk's going to ring up the sales. They're going to send a copy of the sales sheets or the cash sheets to the cashier's department. And then independently, the supervisor is going to read the register data and prepare a cash register sheet. And he's also going to send that to the cashier's department. And I think they have the two pieces of data to compare. And then the cashier's department is the department that's preparing the actual journal entry. So neither the supervisor nor the clerk is actually making an entry into the accounting record. So you've got segregation of duties basically, and they would all have to be in collusion in order to steal cash. Okay. All right, so if you're in the business of taking cash from customers, so think restaurant, gas station, those kinds of things, sometimes there's errors in making change, right? So somebody gives you 20 bucks and their bill was 18.50. You have to make change to give them uh, the difference between the $20 they gave you and the amount of their bill, right? And so sometimes those cashiers will make innocent mistakes in making change for the bills. And so when those are discovered, sometimes we have to make journal entries to true up our cash account. And so the example they lay out here is that if a cash register's record shows $550, but the count of cash is $555, we'd prepare a journal entry to reduce our cash in our general ledger by $5, and we'd put it to this cash over short account. And then we would record sales of $550. Okay, so there's cash $555, but the sales are only $550. So you collected too much cash or you recorded too much cash, and so you just have to reduce your cash by the $5 over short. Okay. Um, Same example, just the other direction. So if the cash register shows 621 or 625, but the count of cash is 621, you would just increase your cash over short by $4. Okay. All right, so two people are assigned the task of opening mail. In this case, theft of cash receipts by mail requires collusion between the two employees. So the person opening the mail enters a list in triplicate of the money received. The list contains a record of each sender's name, the amount, and an explanation of why the money was sent. First copy is sent to the cashier, second sent to the record keeper, and third is kept by the clerk that opened the mail, right? So the cashier deposits the money in the bank and the record keeper records the amounts received. So it's just an example of the segregation of duties in cash receipts. All right, so one of the most important areas is this control around cash disbursements because that's usually where most large thefts occur. And how that happens is usually payment of fictitious invoices. So one key to cash disbursements is to require that all payments are made by check. So very few things will be paid with cash. A lot of companies have a petty cash fund for maybe a small parking fee or stamps or hey, we're out of, I don't know, tape, like small office supply type purchases. Um, Another key is to deny the access to the accounting records by anyone other than the owner who has the authority to sign the check. So, like small business owners often sign checks, and they know from personal contact that the items being paid for are actually received. But when you're talking about large organizations, that becomes pretty impossible. So, internal control procedures, must be substituted for personal contact. So the assuring that the check signer that has the obligation, um, well, I guess the procedures would assure that the check signer that the obligations recorded are properly incurred and should be paid. So a lot of times cash disbursements and invoices that are coming through the door are matched up against perhaps budgeted items, or some approval or purchase order document that says, yep, I I know I should be getting an invoice for these items because I have received these items. And so there's controls like that where expenses are being matched up against projections of items that we were budgeting to pay, and or some kind of receipt document that proves that we actually got the goods that then we're being asked to pay for. Okay. All right, so one way to do that is this voucher system. So it's basically a set of procedures and approvals that are designed to control cash disbursements. So that's done by verifying, approving, and recording the obligations for cash payments, and then issuing checks for payment of verified, approved, and recorded obligations. So a reliable voucher system follows, standard procedures for every transaction. So it applies even when multiple purchases are made from the same supplier. All right, so a voucher system's control over cash disbursements begins when the company incurs an obligation that ultimately is going to result in the payment of cash. So one of the key factors in the system is that only, excuse me, authorized departments and individuals can incur such obligations. So the system will limit the type of obligations that a department and or an individual can incur. So like at Nationwide, we've got limits of authorized limits of basically approval authority. So I think managers aren't allowed to approve anything in excess of, I think, $5,000, I think is what it is. So every company's got different levels. If you're a director, it's in excess of 10. If you're a VP, it's anything in excess of, I don't know, 25 or 30,000. So there's all kinds of limits, and it just depends on the size of the organization and kind of the structure, and it can vary widely from company to company. But um, the example they give here in the book is in a large retail store, for instance, there's typically a purchasing department, and that department should be authorized to incur obligations for the purchase of merchandise inventory. Another key factor that's procedures for purchasing, receiving, and paying for merchandise. They're divided among several departments or individuals, and so these departments, like the department include, there's a department that includes like responsibility for requesting the purchase, and then there's a department perhaps that's responsible for the receiving of that merchandise. And then there's a department assigned to the recording of that activity in the general ledger, typically the accounting department. So to coordinate and control the responsibilities of these departments, the company uses several business documents. And so I think what this slide is trying to show is how those documents are accumulated. So there's typically like a voucher, which is an internal document or file that's used to accumulate the information to control the cash disbursements, so that when those items are received, they're matched up against that voucher before they're paid, basically. All right, so a good system of internal controls for cash provides adequate procedures for protecting both the cash receipts and cash disbursements. So they're asking us here in 1 through 5, which of the following are true statements regarding the control of cash receipts and disbursements. So in the first one, it says over-the-counter cash receipts from sales should be recorded on a cash register at the time of each sale. That is true. Number 2, custody over cash should be separate from the record keeping of cash. True or false? That's also true. Number 3, for the control of cash receipts that arrive through the mail, 2 people should be assigned to the task of and be present for opening that mail. True or false? It's also true. One key to controlling cash disbursements is to require that no expenditures be made by check. Instead, all expenditures should be made for petty cash. True or false? False, right? Other way around. Number 5, a voucher system of control should be applied to only purchases and inventory and never to other expenditures. True or false? That's false. Voucher system can be applied to all purchases. Okay? Alright, so explain and record petty cash fund transactions. So to avoid writing checks for small amounts, typically a company will set up a petty cash system. So postage, courier fees, minor repairs, low-cost supplies, that kind of thing, right? Alright, so the way we establish a petty cash fund is we just move money out of cash, right? So you can have a separate general ledger account for petty cash. And the way that you put a balance into petty cash is you increase your petty cash with a debit and you decrease cash with a credit to establish the petty cash fund. Okay. All right, and so then assuming that we've got a petty cash fund and we've made some different payments from petty cash, each person who received a payment is required to sign a receipt, right? So let's say that on November 27th, after making a $46.50 cash payment for tile cleaning, only $3.70 remains in the petty cash fund. The petty cash fund can be replenished as often as need be, right? So I think what they're trying to show here is just the different expenses that have been paid for with the petty cash fund. So they've got a total of $71.30 of receipts for items that were paid for by petty cash. And so the way that we'll reimburse the petty cash fund is that we'll take each of those expenses, or each of those items that we paid for, and we'll record them to the appropriate expense account, and then we'll reduce our cash. So we had some miscellaneous expenses of $46.50, some small merchandise, courier fees maybe I think it was for $15.05, some delivery expense $5, office supplies expense $4.75. So you debit each of those expense accounts so that you can get those monies to show up on your income statement, right, at the end of the period. And then you debit cash for the net so that your debits equal your credits, basically. Okay. All right, so if the decision is made to increase petty cash, we just debit petty cash, credit cash. If we're going to decrease petty cash, you do the opposite, right? All right, so we talked briefly a couple slides ago about errors in the cash over short account. So sometimes there's errors in making change. If you have a largely cash business, think maybe restaurants or small convenience stores or something like that, right? So, or if the petty cashier fails to obtain a receipt for payment or overpays an amount, cash over short will result. So the way that we fix that is we just debit or credit this cash over short account for whatever the overage or the shortage is. Okay. Okay, so in this slide, I think they're just trying to show us the various services that banks offer. So, for example, if your use of a bank account is more secure for your place, more secure of a place for your cash rather than, hiding it in your bed or in a safe at the office, right? Signature cards are also used so the bank knows whose signature is authorized for writing checks. So in a business, anybody that's a check signer in that business, they will have a signature card on file that the bank uses to match up against the signature on the check to make sure that it's being signed by authorized individuals, right? What else do I want to say here? So really, it's the various services the bank offers. Obviously, bank statements are used so that customers can reconcile their accounts in a timely manner, unless you're, I guess, not a super nerd like me, and then you don't reconcile your bank account. But nevertheless, I digress. All right, so deposit tickets. So here's a Image of a deposit ticket, you probably all have seen this, maybe, I hope, or maybe you just do remote deposit through your phones or whatnot. But this is what a deposit ticket looks like if you've never seen one. Um, Typically, what it'll list all the cash and the checks along with the amounts, and it serves as proof of deposit. Okay. Here's a check, which is also kind of funny because I think a lot of things are done via wire or electronic fund transfer these days. But for those of you who find yourself working in businesses that still actually write checks, this is what a check looks like, right? So it's used to withdraw money from the bank. It includes the maker, the signer, the payee, and the payer, which is the bank. Okay. Here's an example of a bank statement. So once a month, usually the bank will send each depositor a bank statement showing the activity in the account. And then ultimately that's what's used to reconcile against the accounting records of the cash account. All right, so let's talk about bank reconciliation. So bank reconciliation is prepared periodically and it explains the difference between cash reported by the bank and cash balance on the company's books. So the purpose of the reconciliation, uh, the balance in the checking account reported on the bank statement hardly ever equals the depositor's accounting records because there's usually things that are always happening on one side or the other that aren't yet reflected in both until you go through that process of reconciliation. So, cash per the bank, usually you have to add deposits in transit. You have to subtract any outstanding checks because both of these deposits in transit and outstanding checks will be reflected in your accounting records before they're reflected in your bank records. And then you might have plus or minus any errors to get an adjusted cash balance. On the book side, collections and interest. So um, typically on the book side, you're not going to know about any interest that you've earned until you get your bank statement. So that would be an adjusting item on your book side. Any uncollectible items. So if the bank's returned some, let's say some checks you've deposited have come back as NSF, non-sufficient funds, you may not know that until you get your bank statement. And so you would have to adjust your records for any of those uncollectible items. And then plus or minus any errors equals an adjusted cash balance. And if you've done it correctly, when you get to the end, your adjusted bank balance should equal your adjusted cash balance. Okay. Adjusting entries are recorded for the reconciling items on the book side of the reconciliation. So let's go through an illustration here. So steps 1 through 4, you start with your bank balance, you add any deposits in transit, you deduct any outstanding checks to get an adjusted bank balance. And then on the book side, like we just talked about, maybe you've got some fees or interest that you want to add, and then maybe you have check printing charges or NSF fees or something like that that you would subtract to get an adjusted book balance. So same slide, I think the focus here was just on the 5 through 8, but we've already gone through that on the previous slide. Okay. All right, so step 9 would be to make sure that your balances are reconciled, as in they equal, right? And any adjusted entries have to be recorded for the reconciling items on the book side of your bank reconciliation. So here are some examples from the previous slide, how we would record those entries. So there was a collection expense to record collection fee and proceeds for a note that was collected by the bank. So the note collected a $500 note receivable, so we need to reflect that on our books. We need to reflect the collection expense and the net cash that's received. In the second one, we received some interest from our checking account, and so we need to make sure we record that interest revenue. You just do that with a debit to cash and a credit to interest revenue. There were some miscellaneous expenses for check printing charges. Sometimes folks will put that in bank fee expense. Otherwise, miscellaneous is fine too. It just depends on the business. So in this case, they're putting it to miscellaneous expense. So you would have a debit to miscellaneous expense and a credit to cash. And then Woods apparently had a NSF check, our customer Woods, And so we need to make sure that we put that balance back in our accounts receivable because we reflected it as a payment and a deposit in transit. And then the bank said, yep, deposit's no good. So we're going to put the balance back in our receivable that we had originally reduced by the payment we received because it didn't end up clearing the bank. And then we're going to add also the bank fee for the NSF. We're going to charge that back to our customers. So we need to put increase T Woods receivable account by $30 and decrease our cash. Okay. All right. So let's go through this bank reconciliation. So the bank reconciliation determines the true cash balance by adjusting for timing differences and errors. Majority of the items on the bank reconciliation relate to timing differences. The items have either been recorded by the company or the bank, but have not yet been reflected in the other party's balance, right? So, bank reconciliation. On the bank balance side, we add items that have already been added to the book balance but haven't yet been added to the bank balance. We deduct items that have already been subtracted from the book balance but have not yet been subtracted from the bank balance. So that's your outstanding checks, right? Then on the book side, we're adding items that are already added to the bank balance but have not yet been added to the book balance. And we're deducting items already subtracted from the bank balance that have not yet been subtracted from the book balance, okay? In case of an error, whichever party made the error will show the correction as an adjustment. So here we go. So A, December 31st, cash balance according to the accounting records is $1610 and bank balance is $1900. So we put the $1610 and the $1900 up here in the applicable spots, right? Then Gucci's December 31st daily cash receipts of $800 were placed in the bank's depository at night on the 31st, but they don't appear on the statement. So that's going to be a deposit in transit on the bank side, right? $800. And C, check number 6273 for $400 and check 6282 for $100 were both written and entered on the accounting record side, but are not among canceled checks. So they were outstanding on the November 30th reconciliation. Oh wait, those are two different checks. Then we also have two checks for $6,321 or $6,231 for $2,000 and $6,202 for $200. So these are outstanding still. So we've got 400, 100, 200, 2,000, and then check 6231 is on the list with the December cancel checks, but 6242 is not. Oh wait, let me back up. Hold on, let me get my eraser. All right, so they told us that two checks were on the November rec as outstanding, but they're telling us that the 6231 check for 2,000 was listed with the December canceled checks, so that means it's cleared the bank. But 6242 is still not cleared. So let me get my highlighter. All right, so we want to add this $400 that's not cleared, this $100 that's not cleared. The 2,000 they told us did clear, but the 6242 they said did not clear. So those three amounts they're telling us are still outstanding and not yet cleared the bank. So we need to deduct those from our bank balance. The 400, the 100, and the 200. Okay. And then in D, let's see. They say that when the December checks are compared with the entries in the accounting records, it was found that check 6267 had been correctly drawn for $340 to pay for office supplies, but was erroneously entered as $430. So the difference between the two is $90. So that's this error right here. We need to add this to our accounting records. And let's see. In letter E, there's a credit memorandum that indicates the bank collected $500 cash on a note receivable for the company and deducted a $30 collection fee. So we don't have that in our records, so we need to add that to our accounting records, that net $470 cash that we received. And then in F, they tell us that there's a $150 NSF fee for a check from $140 that was received from a customer, and then we had a $10 fee for processing it. So that's our total of $150. And then we have a $20 debit memorandum for check printing charges. So we had not entered those charges before we received our bank reconciliation, we being the company. So we needed to deduct those two items from our book balance. And then if you do the math going down on both sides, your bank balance equals your book balance. You're reconciled. Okay? So that's kind of how that works. Then we have to record the journal entries for the adjustments that we put on our reconciliation, right? So for our $90 that we erroneously recorded the charge at $430 rather than $340, we need to reduce our office supplies and increase our cash by that $90 because we recorded too much expense in our books when we recorded the transaction, right? Then our proceeds that we've collected from a note less the $30 fee, we're going to reduce our note receivable by $500 and we're going to record a $30 collection expense and net cash of $470. So that handles both of those guys. And then our NSF and our check printing fee. So our check printing fee, we're going to put to miscellaneous expense for $20 and we're going to reduce our cash for $20. And then our accounts receivable was related to this Prada ink, and so we need to put that back on our books because the customer's check was no good. And we're putting it back on the books for the $140 payment we received plus the $10 NSF fee, right? And then we're going to reduce our cash. Okay? All right. Let's talk about days sales. So days sales uncollected. So days sales uncollected tells us how much time is likely to pass before we receive cash receipts from credit sales. So if you take your accounts receivable divided by net sales times 365, that'll tell you how many days it's taken you to collect your cash receipts. So the higher the number, the longer the collection period. The lower the number, the quicker the collection period. Right? So if we look at Starbucks versus Jack in the Box, and we look at the trends, let's see. So it looks like Starbucks is really hovering right there around 13, 14 days to collect their receivables. Whereas Jack in the Box looks like they're trending the wrong direction, right? So it's taking them longer and longer and longer to collect their receivables. Is that good or bad? I don't know. I wouldn't say it's excellent, right? The longer your cash is tied up in accounts receivable, harder it is to pay your bills, right? All right, guys, that's the end of chapter 6. So if you have any questions, as usual, please feel free to reach out. We'll see you next time.